So on today's podcast, we welcome Kyle Cole from BMO, Bank of Montreal. And Kyle is here to give us some information on a new program that they have, which is the BMO's Savers Advantage program. And for many of you out there, you may find that this is the solution that you've been looking for. So without further ado, let's welcome Kyle and get all the inside scoop. Good morning, Kyle, and thanks so much for coming back.
Thank you for having me. It's always a pleasure.
So we have seen a lot of changes in the financial market and the real estate market over the last couple of years since the pandemic, and a lot is going on. And so in response to that, I see that BMO has created some special programs for their clients out there. And one of the ones that you were telling me about is the BMO Savers Advantage program. So what exactly is this program?
Yeah, absolutely. Great question. So the BMO Savers Advantage program is a program geared towards clients that are excellent with savings. So in general, either tax-free savings accounts, whether they have RRSPs, anything not locked in, BMO has options to reward clients and potentially increase their mortgage pre-approval amounts by what I call indirect leveraging those investments. So what that means is we just want to see that the investments are there for at least minimum 1 year. And we can go into more detail on how we hypothetically offset to increase clients' mortgage pre-approvals.
So this program is geared for what type of client, or who is it actually targeting?
Yeah. So what I've personally noticed is a lot of clients that have financial planners, they have large investments that don't necessarily want to touch the investments, whether it's long-term RRSPs, even retirees that have large RIFs and don't want to withdraw everything right away to help, put more towards a down payment. Even younger borrowers that have their down payment on the side, they've been saving for many, many years and they have large balances in just say like their TFSAs as well. The other part is also for those who are self-employed. Self-employed, the whole idea is you don't want to pull income out of your business in order to pay yourself if you don't need it to pay the taxes. So there's another program geared towards self-employed specifically, but today we'll just be touching upon the general savings.
Maybe you can explain how this program would actually be able to benefit a consumer. So I guess it's geared towards people who are looking to get a mortgage?
Yes, that's correct. To increase their pre-approval or their borrowing amounts by offsetting the hypothetical investments and so on.
So how exactly would that work? Can you give us maybe an example?
Absolutely, yeah. The best way to understand is to jump right into the numbers. So we'll discuss general situations. So just say you have two borrowers. What happens is with the mortgage pre-approvals, we compare clients' incomes to their debts. And that's what we get, the total debt service ratios. So within that, by looking at their income and their debt, they would qualify for a certain amount. So let's throw random numbers out there and say two clients, they can get pre-approved for a $500,000 mortgage with their down payment already on the side. So other than their down payment, that's already counted in towards the calculations. Just say that they have other investments such as RRSPs, TFSAs, even non-registered, regular savings in their savings accounts. The one caveat to this program is they have to have the investment saved for at least minimum 1 year. Going back to the scenario, they're approved for a $500,000 mortgage. Let's just say after all said and done, they have around $200,000 extra between their TFSAs, RSPs, and all that for a whole year. What BMO is looking to do is hypothetically leverage. So what I mean by that is use those $200,000 and hypothetically say, okay, well, they have great savings habits. Let's get them approved for a higher mortgage, because worst case, they could pull from those investments and pay off that mortgage specifically. So in this scenario, originally pre-approved for 500, they have extra savings on the side of 200. We could actually approve them for up to a $700,000 mortgage now, just by seeing that they have great savings habits there off on the side.
Okay, so if they had an extra $200,000, let's say in an RSP, the bank would take that full $200,000 and add it to the 500?
Specifically for RSPs, this is where it gets a little bit tricky, because within the hypothetical situation is the way the bank looks at it is, what if the client did need to access these funds? So RSPs definitely work very, very differently with withholding taxes. So depending on how much you're looking to potentially withdraw from the RSPs, withholding tax would apply. So in this case, we actually reduce RSPs and RIFs specifically by 30%. So doing the numbers off of that, just say they had $200,000 in their RSPs minus the 30%. That means that about $140,000 extra would be able to be tacked on to their mortgage pre-approval amount, specifically for RSPs. For anything general savings, TFSAs, or non-registered investments, it's a 1-to-1 ratio. No problems there. A lot more straightforward.
Okay, so that would benefit a potential buyer who, as you said in this example, is qualified for a $500,000 mortgage, and maybe they want to just push it a little bit to get into that next perfect house or next stage of a house, but it's just that little bit off. You can use that saved income to enable them to get a little bit more financing so that they can get into that house that maybe their numbers don't quite match.
Absolutely, absolutely. And going back when we last spoke on our other podcast, I'm very, very big on budget. So in this case, this is just a hypothetical situation for clients to say, okay, well, I can get approved for more. However, going backwards, it's really important to look at a budget standpoint, because if you're only approved, or if you're approved for 500,000 and we're stretching it by an extra 200,000, that's a big budgetary change, especially the way the income and all the numbers work out. That's something that you have to take into consideration, is now your mortgage payment is going to be significantly higher. But this is where the investments can play a major factor, because especially in a down market, just say clients have $200,000 in TFSAs, once the market starts to correct on their investment side of things, they can then slowly start to pull some in terms of dividends, depending on what they're invested in, general savings, to then take care of that extra in cash flow, I guess the cash flow amount for that extra 200,000. So it's just kind of where the market goes, and they can use that to their advantage too by keeping their investments invested for the market to correct, and hopefully their investments start to increase over that time frame.
So are there any specific requirements that need to be fulfilled in order to be accepted to this program?
Yes. So the 1 year, it has to be 1 full year of investments or savings saved. We need to see a whole history in terms of statements, investment statements, bank account statements. Along with that, it's a minimum 150,000 of saved income.
And other than that, it's just the qualification numbers that would be pertaining to the actual mortgage, right? So,
absolutely. Yes, absolutely.
This is just extra gravy, I guess.
Yeah, that's exactly. You put it in the best way possible, where it's maybe their pre-approval amount doesn't exactly line up on what they want in terms of a home. And instead of them tapping into their investments to add to their down payment, maybe they're looking for the market to correct and their investments to rise again. It'll give them like a shorter term option to say, okay, well, we can get pre-approved for a little bit more to get to that extra next step based on the price range that we're looking at.
Okay, that's a great program to have as a fallback if somebody's looking at a house, but they've got two in mind, and one is 850 and the other one's 900, and they really want that 900 because it's got everything, but they just don't qualify for that little bit. This is a way that they can get into that. And like you said, the budget is always important. You know, if they're comfortable paying the extra 50,000 in this example for the monthly payments, then they can move forward and get the house that they really want. Yeah,
exactly.
That's
exactly.
excellent.
And it gives them the option not to have to touch their investments and use that as extra down payment, especially if stuff is locked into an RSP. Nobody wants to pay withholding tax because that's 30% you're going to lose off the top. On top of that, there's other tax implications, which we don't have to get into, but not an option a lot of clients should be exploring.
Okay, well that's excellent. Thank you so much for sharing that program. And if anybody wants to reach out to you and get in touch for some more details or to see how that would work out in their scenario and how it could be structured, what's the best way for them to do that, Kyle?
Yeah, they can either call me directly at 647-331-8850, or even best is email at kyle.cole, kyle.cole@bmo.com.
Okay, excellent. And we'll make sure that we put all of that contact information in the show notes as well. Thank you so much, and hopefully we'll have you on again.
Absolutely. Thank you again, Evelyn. It's always a pleasure.
Thanks, Kyle.